price to earning ratio of a company, what is the relevance of the PE ratio, its interpretation, and what is the benchmark PE ratio. PE ratio is not only important for the basic financial management, but it is also very relevant for the fundamental analysis of a company's stock. So PE ratio is the current market price of a company and its earning per share relation to that. This ratio is required to know the valuation of a company, whether the value of the particular share is it's overvalued or undervalued, and also it's used to know the growth trajectory of that or the growth prospects of the company. So these are two major mottos which are served through the calculation of this share. Suppose the company's current market price is rupees 100, where its EPS is rupees 10. It means the PE ratio of that company will be 10. So what will the relevance? If a company say it has a PE ratio of 20, it means the investors they are willing to pay rupees 20 in that stock for a rupee 1 of current earning. You may have heard about the dividend discount model, wherein the price of a share is calculated like dividend divided by KE minus growth rate. K is nothing but the cost of equity or your expected rate of return. Growth is the growth rate at which the company is growing. This is the dividend, and this is the current market price of that particular share. The PE ratio is similar to that, but it's instead of dividend, it takes into account the earning per share of the company. It assumes that a current market price is derived through your earnings divided by your expected return, say KE minus growth rate. Okay, so suppose a company, if you see a company that has a, say, let us take an example. Say a company has an earning of 10 rupee. Let us take two scenarios, 10 rupees. Now the required rate of return is say 10%. And this is company A, this is company B. In this case also the required rate of return is 10%. Now you see the growth rate. This company has no growth prospect as such, but this company, the earnings, they are going to grow at the rate of 5% per annum. So in this case, the current market price, that is more of an intrinsic value of the company, the market price of the company, it will be 100 rupees, whereas in this case it will be like, it is 100 rupees, whereas in this case it will be like 200 rupees. So it's because of the growth prospect, you see, you are valuing more company B as compared to a company A. So it's not the case that the company is overvalued. The company may be overvalued. Say if we compare this intrinsic value with the actual market value, actual market, say the share is traded at rupees 300, then you may say that the share is overvalued. But at the same time, it is also showing us that the growth prospect of this particular company B as compared to company A is higher. So it tells about the growth prospect, it tells about the overvaluation of a company, whether it's overvalued or not. Generally fundamental ratios, they don't tell you about the overbought or oversold position, that you will come to know through technical analysis of that particular share. But for the fundamental analysis, you will see the valuation and growth trajectory at we discussed and the first minutes of this video. So the interpretation is like when company demonstrate high P ratio, it means that either the company is overvalued or is in trajectory of growth. And another interpretation of higher P ratio could be that the company is expected to have increased revenue in the future, and speculation of the same by analysis and the investor has led to a surge in the current stock price. So you know the efficient market hypothesis that is there. So investors, they discount the information at there and only before any materialization in the statements. So they see a growth in company's share. That's why they are willing to buy it at a higher price, because they see that particular growth in the stock of that particular company. They see the earnings potential, they see the market share of that particular very favorably. On the other hand, it may be like undervalued, or the growth projection may not be good, growth prospect may not be good. That may be the another interpretation when the P ratio is lower. So in this case, when company A, we have a company A, company B, we know the earning per share, earning of company is 10 and B is 10 again, and market price per share, as we calculated, in this case market price says rupee 100, whereas in company B it's like rupees 200. So PE ratio in this case will be 10, in this case will be 20. Though the EPS is same, market price is different, and the PE ratio of company B is higher because of the higher growth prospects. So investors see that this company belongs to future. You see, even the traditional companies which may be there, they may have a lower PE ratio as compared to the companies which are growing, which you see that there is a future pertaining to those particular, say for example, renewable energy, if you see it, or semiconductor industry is there. So you will see these types of companies, they will have higher PE ratios as compared to the traditional industries. Now, what are different types of PE ratios? So there are mainly two types of PE ratios: forward and trailing PE ratio. These are more of an absolute ratio. Then we will also discuss about the relative ratios. These are more of an absolute ratios. The relativism is we'll compare it with the benchmark PE ratio. So how the trailing? You must have heard the word TTM, EPS. Then through this we derive this TTM PE ratio. So what is this trailing 12-month EPS or trailing 12 months PE ratio? So trailing PE ratio is most commonly used metric by investors, wherein past earnings of a company over a period is considered. It provides a more accurate and objective view of a company's performance. Suppose a company is there on quarter one, no, say it's 3TM means trailing 12 months. In 12 months there are 4 quarters. So quarter 1, 2, 3, 4, we have earning like 2 lakh, 3 lakh, 3 lakh and 4 lakh, and number of shares outstanding at the end of those quarters is like 1, 1, 2, 2 respectively. So EPS for each quarter will be 2 lakh, 2, 3, 1.5 and 2. So TTM EPS will be the summation of all the EPS will be 8.5. Now if you calculate the normal EPS in this particular example, you see the overall earning for the year will be 2 plus 3 5 plus 3 8 12 lakh, and outstanding share at the end of year is only 2 lakh. We will not add up those share because they are the share which outstanding at the particular date. So we will come to know the EPS is 6 only, but this is not giving the correct picture. 8.5 is giving the correct picture. Why? Because you have taken number of share at the end of the year. You have not taken these particular number of shares into account, because your number of shares, they have increased mid-year. So you have not taken weighted of that, but those particular share. So 8.5 is more accurate. Likewise, if say shares are redeemed, so in that case the picture may be different or it may be reversed, but in any ways the TTM EPS, it will give more objective and more true picture of this from the investor's perspective. So hope this TTM PE ratio, the most important ratio when it comes to the fundamental analysis of particular stock. You will see it and on so many other portals or websites that this ratio is discussed about or talked about while analyzing that particular stock. Now forward PE ratio, it calculates this same way this telling it is calculated, but instead of the past earning, it takes into account the future performance. Say the growth is taken into account, and that's how the TTM EPS is calculated. And through TTM EPS you calculate TTM PE. Now you have TTM EPS, so the TTM PE will be current market price divided by TTM EPS. Say in this example, if the current market price is 85, TTM PE is, then TTM PE will be 10. So that's how you calculate it. Now relative PE ratio is, it's the computation of relative PE ratio. Absolute ratio of a company is compared against the benchmark. Now say you are in a particular industry, say the benchmark for that industry or the benchmark for this particular company. Say the highest PE ratio this particular stock has touched is 100, okay, and as of now it is running at 80 only, so the relative will be like 0.80. so that's how you interpret it in that particular relative strength. So what is a good PE ratio? So this is again very subjective. Nothing clear cut is given for a particular industry or for a particular sector or a particular company. There is no benchmark as such. It all depends on different interpretation. So if you see the average PE of Nifty companies, so in last 20 years it is 20. So in a way we can say that if your PE is below 20, then it may provide a good investment opportunity in a way, because they are undervalued. But at the same time, it may also say that you may see the lower growth prospect in those companies. So that may be one of the interpretation. But the lower is better in a way. It's more attractive investment potential is there because they are undervalued. So it's more on that. You need to see that what is the current market price, and how it is related to the earning potential of the company. So you can compare it to the sector P also. So hope this video was relevant for you to analyze the fundamentally analyze a particular stock and to know about the P ratio. Thank you.